Stock is Soft. Start with current price. Look down. Identify a strong rally in price. Current price down. Can we identify an explosive candle here? So let me use a vertical line to mark the leg out. The first thing is I'm identifying the leg out. The candle that I have marked, can it constitute the leg out? So Rajesh says which time frame we have to mark. A very valid question, friends. So as a swing trader, my execution time frame is generally a daily chart, 75 or 125. These are the three time frames I focus on as a swing trader. If you're a positional trader, you can look at weekly, monthly charts. If you are doing intraday trading, I would say 10 and 15-minute charts are good. If you are doing stocks, don't go below 10, 15. Indices like Nifty, Bank Nifty, yes, you can go down to 3 or 5 minutes. But when you're doing stocks, focus on 10 or 15 minutes for intraday. So as a swing trader, I look at daily 75 and 125. So I've identified the leg out. Next, I need to identify the leg in. So is this candle a leg candle or a base candle where the cursor is? It's a base candle. So here we have the leg in, one candle base structure and leg out. So we need to mark proximal and distal lines. Lowest point of the base to the highest point. So what have we done? We have isolated the base between the leg in and leg out. Now we need to do the quality check of this zone. Is this level fresh? After formation, price has never come back. So the level is fresh. Is it strong? Is it showing you a nice vertical move? Yes, pretty big candle, strong level. And how many base candles are there? Does it fit the criteria? Only one. We can have maximum 6. So this level qualifies on all fronts. So now we can set an alert. If price comes back to this zone, we can initiate a long trade. How to go long? Multiple ways as a trader you can initiate a long trade. One is when price falls down and dips into the demand zone, place a limit order before that. This is called limit entry. You are buying as the price touches the proximal line. So you have placed your order beforehand. But in doing so, what is the risk? What is the risk of a limit entry? After you buy, can price continue falling down and stop you out? So the risk of unknown is there. But if you're a conservative trader, what you can say? Let price come back. When it leaves the level, I will enter. I'll wait for the U-turn. Then I will enter the trade. So this is called a confirmation entry. You're waiting for some kind of confirmation and then entering the trade. Some traders would wait for some candlestick formation. Let price come back here. Let it show me some bullish candlestick. Then I will enter. But friends, in waiting for confirmation, sometimes price can just touch the level and shoot up. So in that case, you may miss out on the trade. So there is going to be a trade-off. So friends, for me, most of my trades are set and forget trades, limit entries. I prefer limit entries in most of my trades. But initially, when you are new to supply demand trading, you may use confirmation methods. But later on, you will realize the best entry is the limit entry. So keep a watch on Birlasoft probable trade here. Yeah, keep a watch on this. So PK has a question. Some people use 2-hour time frame. Is it wrong? No, PK, I would say not wrong as such. But why do I use 125 instead of 2 hours? It is only because of the market dynamics. We start at 9:15 in the morning and the market closes at 3:30. So we have 375 minutes of trading activity in a day. If I use a 2-hour chart, the first 3 candles are complete candles of 2 hours each. That makes it 360 minutes. But the last candle on the day is only for 15 minutes. It does not give me equal candles. So that is the reason I use 125. 125 will give me equal candlesticks. Is that clear? So if you do not have the option to use custom time frames, you can use 120. Will not make much of a difference. So next talk, Acer Motors, 120, 125 minutes. Look at current price, look down, identify an explosive rally in price. Can you all see this rally in price, friends? Can you identify the zone? Start with current price, look down. Can you see this? Is this an explosive candle? Where my cursor is? Very explosive. There is very explosive. There is an open gap. So what is the gap? Gap is an invisible portion of this candlestick. So the candlestick actually is so big. Gap is the best picture of imbalance. So over here, let me mark the leg in and the leg outs. So this candle will form the leg out, base candle, leg in. DBR, drop base rally formation. The lowest point to the highest point of the basic. So do the quality check. Level fresh? Yes. Level strong? Very strong. How many base candles? Only 2 base candles here. So you can set your alert. When price comes back to this demand zone, we can initiate a long trade. So keep a alert, friends. These are probable trades which you can observe. So next, someone was asking me if you make a 2-hour chart, what will happen? So now I'm on a 125-minute chart. There are 2 basing candles. Let me change this to a 2-hour chart. So 2-hour chart, can you see one additional base candle here? On a 125-minute, there are only 2 basing candles. On a 2-hour chart, can you see another base candle here? A third base candle has popped up. But is that a complete 2-hour candle, friends? So this candle is only from 3:15 to 3:30. It's a 15-minute candle. So you should ignore it in the candle count. Don't count it as a base candle. So for you practical purposes, there are only 2 base candles here, not the third one. Is that clear, PK? Because this candle is only from 3:15 to 3:30, not a complete 2-hour candle. So Prabhakar, that is beyond the purview of this workshop. So since you're already part of the program, you can definitely attend the Q&As. We can take it up there. Yeah, so is this clear? So let us go back to 125 minutes, identify this level. I've marked it. So before that, there was a DBD. Yes, Tushar. There was a DBD. If you have gone short here, what has happened? Drop base drop. If you have gone short, it's a SL hit. You are stopped out. So friends, by picture, yes, it's a drop based drop. But should we trade it? There are multiple parameters that we need to look at. But yes, you're right. If you have taken a stop loss, just take your stop loss and move out. If you have not taken your stop loss, can you see how much you will be losing? If you don't take your stop loss, see the amount of loss you will be running into. So it's very important that place your stop loss, take it. So how do we place stop losses? So I'm coming to that. So preferably in these volatile conditions, if you can afford a stop loss on a closing basis. candle close beyond the zone. But that is possible if you are doing equity cash trading. But if you are doing derivative trading, it will become pretty big risk. So I don't recommend in derivative trading take stop losses on closing basis. But yes, if you're an equity trader, you can do that. Take your stop loss on closing. So what I mean, a candle closing below the zone. Sometimes it can so happen, price comes down, wicks you out, and then moves in your favor. There is no close beyond this zone. So ideally, if a complete candle closes below this zone, then you should exit. But what if the candle that you closes is such a big candle? Then you will be losing much more. But eventually it will even out, friends. So even if you are taking a stop loss on trigger basis, a wick, what strike rates can you expect? So if you're good with marking zones, friends, still I would say 60% of the trades would work in your favor, 40% would get stopped out. So anyone in the room expecting a strike rate of 90%, 95%? Anyone expecting 90% strike rate? That you have to be right 9 times out of 10 times to make money. So friends, if you are expecting 90% strike rate, then I should say you should not look at trading because no strategy is going to give you 90% strike rate. So it is all about reward to risk ratios. When you are wrong, you lose small. When you are right, you make much more than that. Yeah. So it's all about having healthy reward to risk ratio. So with supply demand trading strategy, strike rates which we have been achieving is around that 60% mark. But our risk rewards are so favorable that whenever we are right, we make much more than what we lose. So let's look at some supply examples. We have done the demand zone scenario. Let's look at supply. Can you identify the supply zone now? Start with current price, look above, identify a strong drop in price. Current price, look above. Can this be a good leg out candle? The candle that I have marked, is it an explosive drop in price? What do you feel? Not really, right? It's not explosive, not showing you some big move in price. So look above that. Can this be the leg out? Drop, one candle base, and a drop. So you have a leg in, base, leg out. Level is fresh, level is strong, only one candle base. When price comes close to this level, that's where we can look to short. So PK, as long as the wick is small, it's fine. If the wick is very big, let's say this candle has got a very big wick, then not a great leg out. So leg outs ideally should have a full bodied candle. So Tata Power looks good. Keep a watch on this. Pretty close to entry. Next stock, another supply zone. Indigo. Can you identify this level? Start with current price. Look above. Identify a strong drop in price. What is this? Drop, base, drop. So pretty close. Thank you, Gagan. Glad you enjoying the session. So Indigo, there is a nice supply level, fresh level, strong level, only two candle base. So friends, whatever we have done so far is manual marking. I have taught you how to manually mark the zone. But what if there's an indicator which does this job for you? Will it make life simple? If there's an indicator that marks supply and demand zones, will it make life simple for you? What do you feel, friends? So when I started out supply demand trading, there was no indicator as such. So this is a proprietary indicator which me and my team have developed. So let me just apply this indicator on this chart. So supply and demand zone indicator, MAK Trading School. So can you see the indicator has plotted the same level here. So friends, this indicator I would say, plot exactly the same levels. So I would say 9 times out of 10 times my manual way of marking an indicator would be similar. So let's look at some other zones which we had marked, like say Tata Power. Hi, I'm Mahesh Kamath, founder of MAK Trading School and a full-time supply-demand trader. Whenever I interact with a lot of aspiring traders, I get questions like, what is supply-demand trading strategy? Is it different from conventional technical analysis? Is it the same as support resistance? Can one actually trade without the use of any indicators? Is it possible to identify institutional footprints on a price chart? So if you also have such questions in mind, then you must attend the upcoming workshop where I will answer all these questions with the help of relevant chart examples. In this live workshop, I will share with you the exact price action strategy that has helped me and hundreds of my students to make success in the stock market. I will teach you how to identify high probability supply demand zones, how to differentiate between high quality, low quality zones, where to put your entries, where to put stop losses, and when to exit at targets. The beauty of this strategy is it works across asset classes, across time frames. If you are keen to learn this simple yet very effective price action strategy, then just click the button below and reserve your spot before we run out of seats. And I'm looking forward to seeing you live. Yes, Srinivas, it will work even also on a free version. Even if you are having a free version of TradingView, the indicator will plot the levels. However, you will not be able to set alerts. So to overcome that, these alerts are sent on a Telegram channel. So let's look at some of our recent trades that we executed. Let's go through those. So friends, the stocks which I covered earlier are probable trades. You can set your alerts. You may not trade them, but do set your alerts. So AU Bank, 125-minute zone. Can you see this? Drop, base, drop, price came into the zone, quick move out. It's a very good short trade. So friends, do you see here the risk that you're taking is such a small risk and the reward? So generally, supply demand, the mere minimum that we look for is 2:1. So if the trade is offering anything less than 2:1, we will not trade. Minimum we look for is 2:1, and higher the risk reward, much better it is. So AU Bank, there was a trade at the past also on a daily time frame which worked well. Can you see this? Drop base drop, price came back. But what is the risk reward? You're risking, let me just mark it. Just this much and a gain of this big. But is it possible, friends? In hindsight, yes, such a big gain. We had traded this, but we exited quickly. 3:1 was our target, exited around this low. Yes, some traders who are good with managing trades may be able to catch the entire move. I am not able to capture the entire move, but 3:1, is it bad? Risk reward. Making 3 times versus the 1 hour loss. So with a 60% strike rate and 3:1 reward to risk ratio, is it a healthy scenario for a trader? What do you feel, friends? So focus on having good reward to risk ratios, friends. Yeah. So AU Bank, there were 2 good opportunities. One was on the daily time frame, which worked well in the past. Again, on a 125-minute, it worked well. Another trade was a good student trade. I didn't trade this. A student went long on ACC. Can you see this? Rally, base rally gap level. Price came back into this demand zone and see the move out. But is it possible if you're waiting for a confirmation entry here? If you are waiting for a candlestick confirmation, was it possible, friends? Your confirmatory candle closed here. Then you are chasing price. So the best entry is at the zone. So if you put a set and forget trade, it would work really well. Trade that recently I got stopped out was Airtel. And after that, now it has started moving. I got stopped out at the daily demand zone. Can you see this rally base rally level that I have marked? Rally base rally, I identified this level, got stopped out here on this candle, and now it is moving up. So I have taken my stop loss. I'm out of the trade. I'll see for re-entry points later. So stopped out on Airtel. Another good trade was HDFC AMC. It was a 125-minute time frame trade. Can you see this rally, base rally with a gap? Demand zone. Price came back into demand. Solid move out. So what do you see next time? What happened? Next time, is the bounce smaller? So the first entry into the zone is the best entry. Subsequent entries are low probability. That's why the first entry point is the best entry. So in the previous session, we had even discussed about Infosys. Infi, we were planning a long trade. So Infosys here. This was the level rally-based rally that I was looking to go long. Price dipped down. I was waiting for an entry here. Did not get an entry. So coming to your question. So Sachin, you would ask me, you identify level at time, it doesn't come. It happens. So now is there a way, is there a level on top? It did not come to this demand zone. Another level formed up. But when supply and demand is so close by, will you get your reward to risk? When supply and demand zones are close by, ideally avoid. You're not getting sufficient risk reward. Sufficient risk reward is not there. So this was a missed trade. Did not get a pullback here. So LIC Housing Finance, a nice short trade. So can you see this level? Drop base drop. Just touch the level and it moved out. But friends, if you're trading to the short side overnight, not possible in the equity segment, it has to be done in derivatives. So you'll have to use the futures and the options. PK says, what is set and forget and zero? Set and forget, PK, is nothing other than setting your good till cancel orders, GTT orders. You can put your orders beforehand, something called GTT or a good till cancel order. So the way I like to trade is ideally, I place entry, stop loss and target together. So Satish, yes, that falls under multiple time frame approach. So I'm just going to come to that. I was going to come to that. So what we have done now is single time frame approach. Single time frame. So someone was asking me, what if I had gone short on that supply level? I would have got stopped out. So friends, as I said, what we are covering this workshop as the foundation of the strategy. Yeah. So that's more to it. We'll come and discuss that further. So these are some of our recent examples, friends. Recent trades that we have executed. So as you see, there will be trades which are giving you good risk rewards. Trades are going to get stopped out. And there are going to be trades which you don't get entry into. It's all part of trading. So if you want to get good 5 entries, you have to be ready with about 8 to 10 trades. If you plan 8 to 10 trades, you are going to get entries in 4 or 5. Is that clear, Sachin? So there is going to be a scenario where you are going to not get entries. But why think about those? So focus on where you are going to get entries. Yeah.